Welcome to the Colorado Real Estate Leaders Podcast, brought to you by Trailstone Insurance Group, bringing you interviews with Colorado's best real estate and mortgage professionals, empowering you to understand the current trends in the housing market so you can make the American dream your reality. Enjoy today's episode.
Well, it's a great day in Colorado, and welcome to the Colorado Real Estate Leaders Podcast. Today, we have with us Tanner Connelly, who's a loan officer and retirement mortgage planner with Aslan Home Lending Corporation. Tanner, welcome to the program.
Thanks for having me on.
Hey, you're welcome. So I always love to start off with finding out what's your story. What's your background? How'd you get into the mortgage industry in the first place? And if we should write a book and take all of the times we've asked that question, because some of the backgrounds and the entrees into the industry are really, really interesting. I've been loving learning that. So what is your story?
So nobody ever just stumbles into mortgage. You don't go to college to get into mortgage and everything else. I'm a sixth generation Colorado native, born and raised in South Denver. I got in right after college, and evidently I went to college. I went to CSU, Colorado State University, got a degree in agriculture business with a concentration in farm and ranch management and a couple of minors. I graduated actually in the height of COVID. I graduated in May of, I want to say 2020. I had applied to 350 jobs right out of college. In the middle of COVID, 347 of them came back and said, "No way, Jose, we are canceling the job position because of COVID."
Wow.
The only job offer I had coming out was growing beans 10 miles south of the Canadian border, making about $30,000 a year, living in a trailer.
Sign me up.
My dad's an investor. I've been helping him with his books for as long as I can remember. I told him about the only job opportunity that I had, and he looked at me. He's like, "Dude, you run numbers like nobody I've ever seen before. Go into mortgage. It's a hot time. You will do fine." Ended up doing my exam, failed 3 times, eventually got it on the 4th time, couldn't pass a couple of sections by one question, but ended up starting with my dad's original loan officer. Started in as a loan officer assistant for 6 months, learning in the height of COVID how to work with clients, how to collect documents. Now, I wasn't directly writing loans, obviously, but I was given the opportunity to learn from one of the titans of the industry who is doing at about 45 million in his heyday. After that, I finally passed my exam, started writing loans, and I haven't looked back since.
That is quite the interesting side door entree to the mortgage business, growing beans to mortgage. That's great. And also, so did you literally track 350 applications and 347 said no? Did you actually keep track of that?
I did. I'm a big numbers guy.
I was going to say that speaks to being analytical, tracking, being precise, an engineering mindset. And we could probably go off on a long tangent on how beneficial that is to the loan process, because, boy, there's a lot of balls in the air going through an application and documents and conditions and all these things. Well, you've got that dialed right in.
And that's exactly, it was one of those during the entire process, tracking, what companies were taking how much time to get back to me, and just kind of seeing the whole works. It really opened my eyes back into the analytics of actually loans and how the markets continue to shift.
So as we hopefully continue to move past COVID and all, since that was so much of your career at first, where are you seeing the markets go now that, things are changing a little bit again? People are getting back to work or back in the office, I guess, and maybe life is returning to something that resembles before then. Where's the market now? Where are you seeing it?
I'm seeing the market kind of in an interesting spotlight and from, I guess, 2 different directions. So when we're working with borrowers right now, I'm seeing more and more employers being more open to borrowers working truly remotely or truly hybrid, which brings in an interesting concept of, hey, I may be based in Denver, but now my heart and soul really wants to move to Tampa. I'm having a lot more conversations with HR departments as far as, hey, is this really okay? Are we really authorizing this? The other thing that I'm also seeing on a different kind of light and perspective is in 2020, 2021, we saw more of a seller's market. At the end of 2022, it really turned back into a buyer's market. And heading into the 2023 summer, I'm starting to see it already turn back into a seller's market now that people are more accustomed to a higher interest rate than we were, 2 years ago. So it's kind of an interesting time to kind of see both sides of the coin from the borrower's perspective and from, I guess, the mortgage perspective.
Tanner, I heard you say something that I haven't heard on the podcast yet, but you mentioned that you're talking to HR departments now to verify that it's truly okay for the employer to work someplace else. How does that conversation go? Is that part of your underwriting discovery there?
It is. A lot of the underwriters want to make sure that the primary dwelling isn't, past 60 to 80 miles away from the home office. Mm-hmm. That goes by investor. Some care, some don't. But a lot of it's just our due diligence, making sure that, hey, we're not doing, a second home really as a primary or an investment property as a primary. Making sure the HR departments truly are giving us a green light to say, yeah, we can go full blown remote. That's the biggest thing.
That's interesting. So you're planning ahead for a turn down or a condition from the underwriter. You're getting a letter ahead of time from the HR department saying, to be clear, this person is okay to work virtual no matter where the geographic location is. And then now you're submitting that to the underwriter because the whole vibe of working these days, virtual, whether it's here, there, or wherever, it is very much more loose. But yet that hard and fast underwriting guideline used to be you need to live within, and so that's really an interesting observation.
And that's exactly, the one thing that I learned very early on in, I guess, my early mortgage career was how to process and how to start poking out different processing guidelines that may come out in underwriting, how we can easily resolve those on the front end to make it a more smooth transition for the borrowers through the entire process.
That's huge. That's a forward-thinking, analytical engineering mindset where it's like, hit this roadblock. Okay, fine, we're going to plow through it. But next time, because there will be a next time, how could we have prevented it? And then now it makes it easier and better and smoother moving forward. I think that is a huge mindset that a lot of people don't take. They just run into a roadblock and plow through like a bull in a china closet and just let it happen again.
And that's exactly it. I think the one thing that I learned very quickly was if you can think as forward as possible or as many days in the future in a file, the more things you can avoid early on. It's helped us with turn times. Our turn times, I've got to say, I'm blowing a lot of realtors away with how fast we are turning and burning files to get clients into homes. So it's all adaptability in this market.
Smart. One of the things that it jumps out at me when your title shows loan officer. Okay, I get it. You're a loan officer for a mortgage company, but I love retirement mortgage planner. Talk a little bit about what that is and how you serve your clients with that.
Sure. So I think a little bit of a backstory. So when I was getting into the mortgage industry back in 2020, my grandfather was nearing the end. And he was always too prideful to talk about his finances. And I think that's part of his generation where they really don't want to open up about it. They always say, yes, everything's fine, but never, ever ask for help. When we started settling the estate and everything else and started actually going through a deep dive of finances and where he truly was and where he should have been, it was kind of a step back for me to understand where, in my personal opinion, the greatest generation's finances could be. So I took it more on a personal aspect of, hey, if he was having problems with finances, there may be others who may need assistance with the retirement mortgage planning, not the financial planning, but the retirement mortgage and what their equity can truly be leveraged to. So I took it with a grain of salt and started poking around what a reverse mortgage truly is and what it truly isn't. Everybody always resorts to, hey, it's the loan of last resort, which isn't the case. It's more of a strategic plan for retirees to better utilize the equity in their home, whether it be, hey, we're going to take a big lump sum out right in advance, or we're going to put everything into a line of credit that grows continuously for the life of the loan and the life of their house.
And a reverse mortgage is a specific type of mortgage, but being a retirement mortgage planner applies to helping a first-time home buyer think about their loan they're getting. When they move, 4, 5, 7 years later, look at your mortgage in light of retirement. So I think it's a mindset. Yes, reverse mortgages tend to be a option down the road, but I think that you probably have found that some of the people you're advising, whatever their age is, you're bringing that retirement focus into play in the mortgage they're getting right now, because it really can impact retirement down the road.
And that's exactly it. I think one of the biggest questions that I ask, or one of the first questions I ask a lot of my first-time home buyers, or even my second or third-time home buyers, is, hey, what's the long-term play? Are we going to start rolling things into investment properties? Is it to have a house truly paid off within the next 10 to 15 years and just have a bundle of equity sitting there? What's the long-term play? I think one of my favorite conversations, I had a really good childhood friend who's under contract right now. His goal is, hey, I'm going to live here for the next 2-3 years. I'm going to take the equity that I have in the next 2-3 years, roll it into another property, but I'm going to keep this one as a rental for the future and rent it to some college kids.
Yeah.
So it's always having those conversations. It's always the forward thinking in the industry.
Yeah. And if you can play that scenario out, and maybe he does that 2, 3, 4 times over the next 10 years, and you start putting pen to paper and running scenarios, boy, that retirement picture down the road, when you then pull in an actual retirement planner for stocks, bonds, mutual funds, and things like that, they then are now coming into the group of that thought process going, wow, yeah, that really does make sense. And we're maximizing this, and we're keeping the tax advantages and cash flow from rentals. So I just really think that too many people think that the mortgage, we should just get, every time we refinance 30-year fixed. Well, at some point, is that the best play? So what you're describing there is such a critical piece in kind of giving people peace of mind, because they're looking forward. You're giving them that guidance.
I completely agree with you.
So what other type of programs and products are you seeing that your clients are needing in buying or refinancing or investment properties?
I think right now what's really winning over a lot of folks, especially those who have unique financial positions, whether they be self-employed, asset heavy, or just a long-term investor who can no longer buy under Fannie and Freddie traditional investment guidelines, is stuff like DSCR loans, debt service coverage ratio loans, or bank statement loans, asset depletion loans, anything that's a non-qualified mortgage loan that isn't truly a Fannie or Freddie backed loan. That's really where we're thriving right now. That's really where we're seeing a lot of people needing to head in this climate.
And because you're seeing a lot of people that are getting into the realm of planning for the future, buying those investment properties, and all of a sudden that CPA that gave them great tax advice to write off this and that, and all of a sudden, at the bottom line doesn't really show much money. So you need these creative type, hey, look at the cash flow coming through my bank account, though. I've got plenty of money, but it just doesn't show in the tax returns. Is that kind of what you're meaning there?
Yes and no. Obviously, I can't talk about the whole tax aspect because I'm not a licensed tax advisor. However, a lot of the folks are seeing an improper recording of income calculations on their taxes for like bank statements or bank statement loans. There's certain lines within an actual tax filing that we look at the loan officer for being able to record income. Sometimes it's not always recorded correctly. Sometimes they're writing, well, it goes back to what you were saying, they're writing off way too much, but their bank account says otherwise. So from time to time, we'll have to collect 12 to 24 months of bank statements and kind of roll the dice and see where we can come up with. Other times, investors are doing a lot of the DSCR stuff where they may not be able to show the income but they've got the cash on hand, they have the reserves on hand, and the property, is going to ratio out, meaning the rent is going to cover the entire mortgage, if not go over.
You might be buying a 3 or 4 unit property and you're showing these established rental agreements, maybe that are already in place, that have, history. And you're showing that to the underwriter saying, look, these rent payments are more than going to cover my mortgage. So then that's not a traditional, like you said, Fannie and Freddie kind of approval. So you've got to have access to some of these creative products to allow those.
And that's exactly it. It even gets further. I've got a couple of investors right now who are all on their 15th, 16th, 17th door, and they all culminating or combining their mortgages under one mortgage rather than having 6 payments. They only want to have 1 payment. So, there's just different aspects within the non-QM realm that we're able to explore.
That's interesting. So it's not really cross collateralization. It's just give me a big old, or maybe it is, right? It's like, give me one big loan and put liens on all these properties. I just want to make one loan payment.
And that's exactly it.
Wow. That really is creative. That's not common in the industry, I'm sure.
No, I think the more I talk to investors about it, the only other people that we know that will kind of offer it is banks, but even at that, that's hit and miss. That's part of the reason I went from the retail world over into the broker world, is the ability to offer all the untraditional products, because that's the base of what my business truly is all the non-traditional investors and clients. It's really a cool spot to be in.
It sounds like that's your sweet spot of working with the people that need those kind of products, investors, people that are really thinking big, way past the first or second investment property, but starting to really see that as their, investment strategy.
And that's exactly it. A lot of the people that I work with are always the ones that get told by 3, 4, or 5 other loan officers that they can't do something. And it's because those loan officers don't have a product platter that we do. And that's the biggest unique thing about where I am and what we're doing now is, if I don't have the product, we can go find the product, we can add the product, or we get creative on how to get a product done, all obviously within guidelines. But I haven't really had any issues with any of the borrowers getting them to closing. Whatever the need or whatever the issue or hurdle may be, we get them there.
Well, in my mind, I'm hearing what you just said. It's almost like, ooh, you ought to grab that as a tagline. We get them there. That's an awesome little deliverable. And I just can sense your approach to serving your clients with being genuine, teaching, educating them, and just rolling up your sleeves and getting it done. So, Tanner, thank you so much for coming on. If someone is interested in reaching out and connecting with you, what's the best way that they can do that?
On all social media platforms, I am either Tanner Connelly, TannerConnelly, or you can find me at Tanner Loans, or my website is www.tannerloans.com.
Excellent. Well, Tanner, thank you so much for coming on today. It's been a real pleasure talking with you.
Hey, likewise. Thank you guys for having me.
Thank you for listening to the Colorado Real Estate Leaders Podcast, brought to you by Trailstone Insurance Group. To learn more about the topics mentioned on today's show or listen to past episodes, visit www.coloradorealestateleaders.com.